Hello everyone, welcome back to Prime Accounting Classroom, where we bring clarity to every concept. If you truly want to understand accounting, you must start from the foundation. Before debits and credits, before financial ratios, before complex adjustments, you must understand what accounting really is, who uses accounting information, what financial statements are, and how different business entities present their accounting information. So in today's lesson, we're going to break all of that down in a simple and practical way. Let's begin. 1. What is accounting? At its core, accounting is the process of identifying, recording, classifying, summarizing, and interpreting financial transactions. In simple terms, accounting is the language of business. Just like English is used to communicate ideas, accounting is used to communicate financial information. Every time a business sells goods, pays rent, buys equipment, receives cash, pays salaries, those activities must be recorded properly. Why? Because businesses need to know, are we making profit? Do we have enough cash? How much do customers owe us? How much do we owe suppliers? Without accounting, a business is operating blindly. The main purpose of accounting, the main objective of accounting is to provide useful financial information for decision-making. That's it. Accounting is not just about recording numbers. It is about providing information that helps people make better decisions. 2. Who uses accounting information? Accounting information is not just for accountants. There are two main groups of users. 1. Internal users. These are people inside the business. Examples: owners, managers, directors. They use accounting information to plan future activities, control operations, make strategic decisions, evaluate performance. For example, if profit is decreasing, management must investigate why. 2. External users. These are people outside the business. Examples: investors, to decide whether to invest; banks, to decide whether to give loans; suppliers, to decide whether to give goods on credit; government, for taxation purposes; employees, to assess job stability. Each of these users depends on accounting information for different decisions. That is why accounting must be accurate, reliable, and transparent. 3. Financial statements. Now, how is accounting information presented? Through financial statements. Financial statements are formal reports that summarize the financial performance and financial position of a business. There are 4 main financial statements. 1. Income statement, also called statement of profit or loss. This shows revenue, expenses, profit or loss. It answers the question, did the business make profit or loss during the period? Basic formula: revenue minus expenses equals profit or loss. 2. Statement of financial position, also called balance sheet. This shows assets, liabilities, equity. It answers the question, what does the business own and owe at a specific date? It is based on the accounting equation, assets equals liabilities plus equity. This statement shows the financial position of the business at a particular point in time. 3. Statement of cash flows. This shows cash inflows, cash outflows. It answers, where did cash come from? Where did cash go? A business can make profit but still have cash problems, and this statement explains that. 4. Statement of changes in equity. This shows changes in the owner's equity during the period, such as profit, loss, owner's investment, drawings, or dividends. Together, these 4 statements give a complete financial picture of a business. 4. How different business entities present accounting information. Now let's talk about business types. Not all businesses are the same. The way accounting information is presented depends on the type of business entity. There are 3 major types. 1. Sole proprietorship. This is owned by one person. Examples: small retail shops, freelancers, local businesses. In a sole proprietorship, owner and business are not legally separate. Profit belongs entirely to the owner. Financial statements usually show capital, drawings, profit. Equity section will appear as owner's capital. 2. Partnership. This is owned by 2 or more people. In a partnership, partners share profit and loss. There is usually a partnership agreement. Accounting presentation includes capital accounts for each partner, current accounts for each partner, profit-sharing ratios, Financial statements must clearly show how profit is distributed among partners. 3. Corporation, limited liability company. This is a separate legal entity from its owners. Owners are called shareholders. In a corporation, the business is legally separate. Shareholders have limited liability. Financial statements include share capital, retained earnings, dividends. Equity section is more complex compared to sole proprietorship. Corporations usually follow stricter accounting standards because they deal with public investors and regulatory bodies. Why presentation matters. Different entities present information differently because ownership structures differ, legal responsibilities differ, regulatory requirements differ, but the goal remains the same: to provide useful financial information for decision-making. Bringing it all together, let's summarize. Accounting is the language of business. It records and communicates financial information. Internal and external users rely on it. Financial statements summarize business performance and position. Different business entities present accounting information differently. If you understand this foundation, everything else in accounting becomes easier. In the next lessons here on Prime Accounting Classroom, we will start breaking down each financial statement in detail, line by line, and understand how transactions flow into them. Because once you understand the structure, accounting becomes simple and logical. If this lesson helped you, don't forget to like the video, subscribe to the channel, and turn on notifications so you never miss a lesson. Remember, at Prime Accounting Classroom, we bring clarity to every concept. See you in the next class.